Monday morning, September 6th, the first Monday of September, which always feels like the real deal has arrived. And in that regard, here in Dubai this morning, the news on the radio, the talk shows was, oh my God, the traffic is insane. I can't get to work. I can't get to school. So, as I talked with a friend in Delhi last week, they're celebrating that there's traffic jams back in New Delhi. So I suppose we should be celebrating that there's traffic jams back in Dubai, and that the tube in London, maybe, Kate, is packed with people, and all of those sorts of things. But no, it's not. She shakes her head.
I don't
Well,
use it. I
I
wouldn't
don't
know. I
use
don't
it.
use it.
I wouldn't know. I read it in a book once.
I drive my gas guzzler. Yeah.
Yeah, I drive my gas guzzler. Well, Omar appreciates that. Let's kick off this morning with Omar Najia, a global head of derivatives of BB Energy, our regular Monday morning commentator. Omar, your thoughts this Monday morning? Asia opening down a little bit soft, 1%, sort of continuing a trend of last week, even in the face of a major storm that knocked out quite a bit of production. Your thoughts?
Yeah, so I think market is correcting. So I don't think the storm is very interesting. You had a lot of hype, and again, I don't think news stories drive anything in markets except noise. So they add a little bit of fluff to what's going on, and people start pointing and oohing and ahhing and all the rest of it. But if you look at in my opinion, if you look at oil, I think the trend is higher. So I'd be looking for a move higher, strong move higher to finally arrive, I don't know, next week, next 2 weeks max, something like that. And for us to start trending higher. I think the market's trading plus or minus $68 on WTI. Maybe we get down to, I don't know, maybe 65 even, something like that. But I think the next stop is going to be mid 70s, and after that mid 80s. So I'm quite bullish on US equities. Everybody keeps forecasting the imminent collapse of US equities. Doesn't seem to happen. So, I'm cognizant of the fact that it's possible that, we hold and we wait.
Every day that goes by, we're one day closer to it being an inevitable outcome, although one might have been saying that for 10 years.
Yeah, exactly. So, and again, you've had this COVID, whatever it is, Delta, the last one, and like a mutant variety or whatever it is, basically. And, they're forecasting the imminent whatever, and, nothing's happened as well. And, I'm not a big time believer in all these, boosters and then, a booster for the booster and all the rest of it. It seems the only thing it boosts is profits of pharmaceutical companies. So, you've had the vaccine. Why should this be any kind of, different? So as long as people have been vaccinated, then I'm not worried about COVID going forwards.
Well, let's welcome Kate Dourian back to the table. Good morning, Kate. MEES contributing editor and non-resident fellow of the Arab Gulf States Institute in Washington. Has Omar reason to be bullish, Kate? We're seeing Ida storm last week knock out 2 million barrels of production in the Gulf of Mexico. We had sort of significant draw on inventories, and yet oil prices still struggle to sort of get above that 71, 72 on Brent.
Yeah, part of it is inventories are falling. So I don't think it's going to really decline very sharply, because you still have a supply deficit at the moment, somewhere around 700,000 barrels a day. Even though demand isn't really expected to come back, you still have a demand, gradual increase into 2022, but people expect a surplus come 2022. So it's a sort of balancing act. But I think prices have sort of been flirting around with the 70 level. They fell below, they've gone back up again. Now you've got another hurricane, but I think that's short term, and we're not really looking short term. So the Delta variant is still with us. Yes, people are being vaccinated, but not in all parts of the world. But I think we're learning to live with it now. The reason why there are traffic jams here is not because there's so many cars on the road, especially in August, but it's because they're making way for bicycle lanes and installing fiber optics. So it's very much a change in city planning. And I think that sort of, looking forward, that's really going to impact mobility.
Let's also welcome back to the table Marc Ostwald, Chief Economist and Global Strategist at ADM Investor Services International. Marc, good morning. We're seeing overnight Saudi Arabia slash its OSPs for Asia, maintaining them flat for Europe and America, but nonetheless, quite a deep discount to Asian refiners. How do you interpret that?
I think they're just facing the reality of the situation of the extensive lockdowns and extended lockdowns that they've had in Asia, and they're just trying to attract a bit of business. From what I've been seeing, that we're at a stage now where the Chinese are also seeing a pickup in demand and activity. So they're sort of, I think what this is effectively a balancing act between the drop in the prices that we'd seen and basically evening things out, trying to sort of offer a form of discount to Asia where demand is weak at the moment outside of India, but particularly East Asia, against ensuring that there's the prices stay the same in Europe and Americas.
Marc, I'm seeing you're in an office, not a bedroom. Is that a new recall back to London, or what's the city of London looking like?
Yeah, the ADM offices have reopened across the whole of EMEAI. So as of today, and I'd have to say I've been in a few times in the last couple of weeks. The trains were noticeably busier in London today. So there's more people coming back in.
Normality is returning. Omar, when we look at the sort of wider structure of the market vis-a-vis, how does it get up to that next sort of level, if you like, ultimately in the reasonable time window? One might make argument that sort of 22, 23, there's very solid arguments that one would see the deficit of new capacity driving prices up above the 80 handle. But what do we see in the coming months? What is the next lift? We've kind of been stuck in this range for a while, and we've had a correction. What lifts it further, do you think?
Well, I mean, look, there's many ways to look at markets. If basically looking at supply and demand and adding it all up and coming up with a +1 or a -1 was the way to do it, then everybody would make money, but everybody doesn't. So
well, everybody made money recently, didn't they? I mean, it was pretty simple up till not so long ago for you and your peer group, as competent and capable as you all are. It's been a bit of a free gravy train for the last while. Now you got to earn your money, maybe.
Well, no, not really. I mean, if you remember back in February, I was being told, I mean, even on here that, nothing is going to ever come back and it's going to change the world and I don't know what. And forward 6 months and, everything's normal again or pretty close to it. And back in February, I said that WTI would get to 80. And I think you said 80, like as in a question,
And I'll say it again if you want. 80.
Yeah, 80. So yes, I think basically, so what's the market is driven by a lot of things, by exogenous market, by sentiment, by perception, by whatever you call it. And I think basically the mood is ebullient. I think the mood is to the upside. You can see that in the resurgence of cryptocurrencies. You can see that in the fact that everybody keeps telling me that US equities are going to break down and fall, and this time it's the last high, and retail investors keep coming in. So at the end of the day, I think basically what gets us higher is OPEC defending prices, is basically demand being stronger than people suspect or assume. So, for example, I read a story a couple of days ago. Cathay Pacific was saying that their share of flying was basically 4.6% of what it was in 2019. Now, if I told you that they're flying 4.6% of 2019, would you bet that it's going to go up or down? I certainly wouldn't bet that we're going to go from 4.6 to 0, because you go from 4.6 up to 100. So, I think it's the same across the board. When Biden spends, another 2, 3, 10 trillion, whatever it is, blah, 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 I mean, you have to understand. I think people fail to kind of see that if there is a great big dip coming, then it's obliteration time. It's not going to be like a little dipette. It's going to be like bye bye the West and all this kind of stuff. So I think they keep printing money no matter what. I think they keep forget about tapering no matter what. And I think they're in a bind. And as long as that happens, then people keep bidding. What happens ultimately, I have no idea. At some point,
well,
like
Kate is going to tell you. Kate will tell you now. Don't worry, you're in good hands.
Oh, what am I going to tell you?
You're going to tell Omar what's going to happen next. I mean, the point he makes, a reasonable point. We're seeing Australia finally wake up to the fact that vaccines exist and that they're a better approach to locking down everything to go after that zero infection rate. And we've seen Asia follow the zero infection rate strategy and now slowly come to the vaccination solution. And as they do, perhaps that does bring that extra level of demand, that aviation jet fuel demand. Your thoughts on that?
I read something really interesting yesterday about the United States and the economy, and they figured that the Democrats, states where the Democrats are a majority, where you have more vaccinations, actually have contributed. They traditionally contribute more to the U.S. economy. It's something like 65% versus the Republican states where you don't have that much vaccination, where you've got, this sort of surge in the Delta variant. I think the recovery is still uneven. And I think that's one of the reasons why the OPEC Plus want to sort of maintain this monthly meetings. It's more of a roadmap, they can tweak it up or down. But, at the end of the day, it is about supply and demand. I mean, look at gas prices. They've been surging. So you're getting a displacement of gas even in Europe to coal, which is unheard of.
But that demand piece that has moved the oil price for the last, 20 years maybe now, but let's just take it in the last decade, that marginal demand growth has always come from Asia. It is what lifts these barrels higher. Does Asia continue to serve that purpose going forward?
I think China's starting again. You're seeing China import more crude oil, India not so much. That's why I say it's sort of uneven. But I think the demand forecast, I think, was actually quite low. That's one of the reasons why you had Biden calling on OPEC Plus to increase production, because I think their demand for both the IEA and OPEC was low, so that OPEC now is going to raise its demand forecast for next year from 3.8 million increase to 4.2. So I think that's part of the reason why. And, the market is quite comfortable at the moment. So you see outages in Guinea. I think that's one of the stories that was in the digest, and a lot of people don't know that Guinea. It's actually one of the smaller. Yeah, it's one of the smaller OPEC producers, tiny, but still. You've got Libya, which is in sort of constitutional limbo. You've got disputes between the oil minister and the head of the national oil company. No disruption yet, but there is potential for that. Iran is off the market. There's no renewal of the nuclear talks. So that sort of suggests to you that the market is quite comfortable. Forget about, the stock levels are coming down. They'll probably come down even more in the US after the hurricane. You've got another one brewing. So I think the market is quite comfortable. So barring any unforeseen change in the Delta variant, new variants emerging, I think you're going to see the market quite balanced and not sort of, unless there's a shock. I think we're going to sort of carry on autopilot.
Carry on as you were. Carry on, Mr. Humphreys. Is that what the phrase used to be? But nonetheless, Marc, last Friday we had a rather surprising job number out of the US, and the idea that the sort of bounce back ultimately seems to have hit a wobble. How do you interpret the jobs report out of the US and this sort of idea that this spring back of the economy now is sort of coming to its end? The idea that simply by turning the lights on again you have light, but do you have growth? Your thoughts on where that jobs number, what it tells us and what impact it has on the Fed?
Well, all the jobs data is always very noisy. And to be honest, I didn't actually think it was particularly weak. What we had was a combination of three factors at work.
I mean, it was a third of street expectations.
That doesn't matter because it
yeah.
was only one category. It was leisure and retail.
Okay.
And you'd had growth of 400,000 2 previous months, so there was a corrective element there. You also had, the infection rate rising, which we saw, if you looked at mobility data for people going to restaurants, it dropped off. So I think it was just a one-off because actually the rest of the payrolls were actually at the same level as 2 previous months. So still, labor demand still strong. There is still, we're going to get the JOLTS data this week. We're going to be looking at 10 million open position, unheard of. The unemployment rate came down. The underemployment came down. So I don't think it was that weak, but it's probably weak enough for the Fed to push back a little further. And as far as most market participants are concerned, as long as they don't make a taper announcement in September, no one cares. It's basically just carry on as you were. It's this learnt response of buy the dip in pretty much any asset. You're even seeing it with China. This is the interesting aspect. I think China's a good microcosm. All this regulatory intervention, any market you care to think of, which keeps on upsetting that. But yet the market capitalization in China is actually bigger than it was at the beginning of the year, despite the fall in the CSI. So
don't bet against the Fed, I suppose, is the standard tale on that. Omar, on the fundamental side, in terms of money markets, we're seeing the net long position on the Brent grow in the last week or so. The significant increase in net long positions. Your thoughts there on the structure of the market, of that sort of non-professional money coming into the market?
First, I just want to say I agree completely with Marc, basically. So it's all a matter of perception and how big news organizations want to kind of digest the news and tell you stuff, which I don't think is true. And I agree completely with what Marc said. And as to what were you saying? Sorry,
the net long position on Brent.
Yeah. So the net long. So I had a call last week from somebody at the CME, and she was, we're the CME, and do you need any information? Blah blah blah. We can send you, open interest, and we can send you all this data and all this kind of stuff. But at the end of the day, so what? So basically, data doesn't tell you. Open interest is growing, but so what? It doesn't tell you how risk averse or how scared or how confident, or it doesn't tell you anything. It just tells you people are buying, or people are not, or there's more, selling, but it doesn't tell you the conviction that these people have. So I'm not. It doesn't bother me in the slightest that people are, either long or short or whatever. What I look for is how, the conviction of people. So what Marc was saying is that when you have conviction in the market, it doesn't really matter what kind of news you throw at it, because they have conviction. They buy the dip, they buy a little bit, they buy a little more, whatever it is, but they don't run for the hills. And I think that's the important bit. So whatever the data is saying, I'm not seeing people running for the hills. So until and unless I see people running for the hills, then I'm not worried about the markets.
Running for the hills, Kate, in terms of where the tightness on this market is, are we still in a managed supply side of the market? Obviously, OPEC Plus have signed off on a 400,000 barrel a day per month increase every month till they get all of their cut done. Are we moving out of a managed market piece, and now the fundamentals are there, or still are we relying heavily on the pillar of OPEC managing this market very micro?
I think they will continue to manage. The last meeting was sort of was a whimper, wasn't it? There was no bang, there were no disputes. I think everybody's now comfortable. But don't forget that not all of OPEC Plus members can actually produce at their new quotas. You've got Saudi Arabia's got the capacity, the UAE's got the capacity. Iraq may have the capacity, but not the export capacity at the moment. So I think it's, Iran is still offline. So you've got Algeria, Nigeria, which can't produce much higher. So you are going to have more supply, but not as much as expected. And then you've got Russia with this unreasonable 11.5 million barrel a day baseline, which they haven't produced at, and they weren't even before the cuts came into effect. So I think, yes, you will have management, you will have they will. They're acting more like a central bank at the moment. Sort of tweaking things as things are. And let's not forget that the weaker dollar as well had an impact. As a result of the so-called, the apparent weak jobs report. So that's also the inverse correlation between oil prices and the dollar. But I think that there's more uncertainty on the demand side, which is why you have this OPEC plus roadmap. So, which
Kate,
can be
any
tweaked.
particular insight you can share or views on what's happening in Iraq? We're seeing some big changes in the IOC's participation there. Exxon, BP, Shell pulling out. Now we've got Total signing a big deal. Your thoughts on that?
Well, I don't think BP's pulling out. They're just restructuring the joint venture so that they get it off their books. So, it's part of the net zero targets and showing a greener face. Yes, Total, which didn't really have too many assets there. They have a small asset in one oil field in Iraq and an interest in Iraqi Kurdistan. But yeah, $27 billion is a bit of a misnomer because what they're actually investing is $10 billion in 4 projects, which is gas, water, oil, and solar. And the solar bit and the gas bit, sort of is in tune with Total Energy's new greener image. But yeah, I think it's, ExxonMobil, yes, is on the way out. Shell has already left. But the fact that they've been able to attract this, I mean, it may be that they rushed it, that you don't have all the pieces in place because the elections are coming up and the prime minister was pushing for it. But I think it's also Emmanuel Macron. He's made 2 visits to Iraq in the last year. He's taken, he contacted Iran's new president yesterday. So I think Macron is sort of driving the investment, or at least France is driving the investment in certain regions where others are pulling out. And
well,
that
Total
is reflecting.
The Total and Eni have done very well in the region for the last few years, while the Anglo side seems to be withdrawing. Let's go to the survey question and get the view of the room on some of this stuff. Saudi Arabia slashed crude prices for Asia over the weekend, OSP prices, which signals 1, demand concerns, or 2, global markets are well supplied. What is your view? And then we'll get this panelists to give us their thoughts for the week ahead. It is Monday morning. Brent oil prices are down by 1%. Marc, you're returning to work this morning. Kids are going back to school, all of that sort of normal stuff. What's your thoughts for the week ahead? What will you be watching? Any particular data points?
I think it's really all about the central banks this week. So we've got the RBA tomorrow. They may defer the taper, but I don't think they're in that sort of mood. They've emphasized fiscal policy is where it's at, so they're not going to stop tapering. That's not a signal. ECB, Bank of Canada on Wednesday is interesting simply because they've been hawkish, but they're going to have to pull back now because of the rise in infection rate, really disappointing GDP. And then the ECB on Thursday is the big one, effectively. And that's, we're going to get a classic, when's a taper, not a taper. And to be honest, it's all about their forecasts, and people are focusing on the short-term forecasts, which they'll revise up, but the long-term forecasts, they won't. So they could actually not do anything, not even a faux taper. And that would definitely give markets quite a big boost if that were to happen. And even if they do say they're not going to be buying bonds at a significantly higher pace, they'll basically make it clear they're going to be pouring in money for a very, very long time.
I mean, it only seems like a few weeks ago, Marc, that we were sitting on the doorstep of the New Zealand central bank being the first to move to possibly, we were debating whether it was going to be a 1/4 or a 1/2 percentage point of rate hike. And now we're like, not even tapering is drifting off the table. What's shifted in that few short weeks?
I think it is. It's a combination of incoming data being seen as disappointing. It's a perception thing, as Omar was saying. A lot of this is perception. People want things. Actually, I think in the longer run, the proper perception of this, there's a sort of market perception, and there's what should be happening, is that people should realize that this is going to extend the growth recovery for much longer than people expect, and it gives us an outlook for 2022 which is in fact better than expected. And we will basically, at some point, be refocusing in on the inflation problem that everyone's going to have. I think Canada is a good example in that particular thing, because most of the price increase, most of the rise in inflation that it saw last month was all down to housing. And it's going to happen in the US, the UK, many parts of Europe. And this is going to be a problem, except, of course, in Europe, they don't include housing in CPI. So it's not as bad there, but it's optical.
Omar, your thoughts Monday morning, the week ahead. The prices in Asia, as we said, have opened a little bit soft, but holding on to that sort of 70 on WTI and 72 or so, or 71 and change on Brent.
Well, again, more of the same. So you're going to have, very, very simply put, you can either view this as, glass half full or glass half empty. And I think basically markets are correcting and the glass is half full, and I'm bullish, and I fully expect WTI to get to 82, maybe even have a shot at getting to 90 something.
82?
Yes. I love it when people say that. Because, the worst thing, if you remember, the last time we had like a big correction, again, I was on here and everybody was talking about, here we go, we're going to 100. So as long as we can have these discussions and not everybody's agreed, and some people, maybe we stay around here for a while, blah, 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 then I'm really happy. The moment everybody starts saying, 100, here we come, and yes, and buy equities and Bitcoin's going to fly and all this kind of stuff, that's when I get worried. But as long as people are saying, don't buy, it's a bubble and this is another bubble and I don't know what, and they're going to taper and let's listen to what he says and all this kind of stuff, I'm happy buying.
Happy buying. Let's get the survey result and give Kate the last word, who's happy not getting on the tube. Saudi Arabia slashed crude prices for Asia over the weekend, which signals demand concerns. There's still weakness in the demand profile on this market, which I suppose a lot really now depends, Kate. There's been a few comments on it. We've seen some headlines, data points. China is coming back. Where is the China demand story really probably guide where this market goes?
Well, I mean, they were dipping into their reserves at one point when imports were lower. So I think that's picking up again. And, the economy, obviously the Chinese economy is on a growth pattern. But I was interested in, as you're saying, 82. I mean, US oil production has been on the rise and it's expected to rise even more next year. So that's going to add to the surplus. I mean, I'm not an oil trader, so I never predict prices anyway, because I'll always be wrong. But, I think we've gone away from that super cycle narrative at the moment. But generally, commodity prices are holding up. You've got oil and gas, and gas is sort of not really following oil, but the gas story in Europe is different. But that's your balancing market, Europe, and we're coming into the winter with a deficit. So I think yes, generally that'll keep the whole complex up. But for your survey questions, I would put both, because let's not forget Aramco sets prices based on market fundamentals. It's not just purely it's a combination of both, I would say.
Of course, yeah. Well, let's wrap it up there. A combination of both, demand concerns, a lot of oil. And I think one thing to also watch out for this week is data points. The inventories are coming out of the US Ida storm. You're going to see a surge in production or slow in recovery, or inventories decline, or there'll be some big moves there that might grab a few headlines and distort the outlook initially, but something that may give some direction to the market. But I would certainly concur that we're probably in a range bound for now until there is some trigger. But look what happened to gas. Maybe oil, as Jorge said yesterday, is going to have some spikes of its own, and watch out for that. Omar, thank you so much for joining us this morning in Dubai. Marc in London, no longer in Poland. We'll have to remember that. Kate also in London, thank you for joining us this morning, and everybody else. We'll see you here every morning at 10:30. The markets in Asia opening today down a little, 1%. We'll see if that continues. All the best.